As you saw this morning, we've announced our intent to unite Warner Media and Discovery to bring together their complementary strengths to create a new company with a solidified position in global direct-to-consumer. We're excited about this opportunity for it creates Warner Media and Discovery and what it also does for AT&T, our customers, our employees, and our shareholders.
Hello ladies and gentlemen, and welcome to my channel. My name is Wietse Kouwboer, and in today's video I'm going to talk about the announced merger of AT&T's Warner Media and Discovery. If you follow my series A Road to 100,000, you know that I recently bought some AT&T shares. AT&T is one of the biggest telecommunication companies in the world. They are mainly focused on the US, and besides offering broadband and wireless networks and telephone subscriptions, they also own Warner Media. And Warner Media is better known for HBO, CNN, or Warner Bros. A little while ago, AT&T announced that Warner Media and Discovery are gonna merge. And this will probably take place next year in the summer, somewhere mid-2022. And in today's video, I wanna go over the details they announced and also what this means for you as an investor. And if I want to buy more shares, hold my shares, or maybe sell my shares. So 3 years ago, AT&T decided to buy Warner Media for $85 billion. That's a lot of sandals. And AT&T thought that offering streaming services would really help them in their business. But after 3 years, they kind of came to the conclusion that it's pretty tough to integrate a media company with a telecommunications company. And they decided that it was better off taking it out of the company and merge it with another media company, turning it into a big media conglomerate with worldwide access. And that other media company is Discovery. Media and streaming companies are a very hot topic today, and there's a lot of money to be made in that sector. But the competition is also fierce. Think about Netflix and recently Disney Channel, but also Prime from Amazon. And then of course you always have local players. For example, in the Netherlands you have Videoland, in America you also have Hulu, and many others. So one of the most important things in the media and streaming business is your budget to create more content, because content is king. If you have the best content, people will follow you and join your streaming service. The estimated budget for content creation for the new company is around $20 billion. And to compare this with Netflix, for example, they have a budget of $17 billion. So they really want to measure themselves with the big streaming companies in the world. For this part, I want to show you guys the article that AT&T posted on their website for investors. As you can see here, AT&T's Warner Media and Discovery creating a standalone company by combining operations to form new global leader in entertainment. Under the terms of the agreement, which is structured as an all-stock reverse Morris trust transaction, that's a whole lot of difficult words, but what it basically means is that AT&T will receive $43 billion in combination of cash, debt securities, and Warner Media retention of certain debt. So what this basically means is that AT&T will lower their debt outstanding with $43 billion. And AT&T shareholders will receive 71% of the stock of the new company that is created with the merger of Warner Media and Discovery. And Discovery shareholders will own 29%. So if you own a share of AT&T or of Discovery, you will receive a stock in this new company, and it still has to be announced what the name of this company will be, but we expect more information about that in the end of this year, maybe beginning of next year. So what are the benefits for you as an investor? Well, they think they can create substantial value by bringing together the strongest leadership teams in content creators in high quality series and film libraries in the media business, accelerating both companies' plans for leading direct-to-consumer streaming services, uniting complementary and diverse content strengths with broad appeal. Warner Media, robust studios and portfolio of iconic scripted entertainment, animation, news and sports, with Discovery's global leadership in unscripted and international entertainment and sports. So they believe that their content is very complementary to each other and they can reach a wider audience. So they will form a new company that will have significant scale and investment resources with a projected revenue of around 52 billion and an adjusted EBITDA of approximately 14 billion and an industry-leading free cash flow conversion rate of approximately 60%. And with the operating income of almost 14 billion, looks pretty good to me. Creating at least 3 billion in expected cost synergies annually for the new company. For AT&T and its shareholders, this transaction provides an opportunity to unlock value in the media assets, and this is something that the CEO of AT&T can explain the best.
First of all, we announced that we're going to take our media assets and spin them out and combine them with Discovery. We think that's ultimately good for a current AT&T shareholder because our media asset right now is trading at a multiple. When you look at the value of it suppressed within the AT&T stock, that isn't equal to what other media companies are getting. And we think not only exposing that to the market, but frankly, giving it the attractive characteristics of combining with Discovery, a deeper content portfolio, stronger combined international operations between the two companies, $3 billion of synergies that can be brought in, that this is now a business that's well-tuned to be successful in direct-to-consumer and enjoy the kind of valuations that leading direct-to-consumer businesses are in fact achieving. And so we believe there'll be a value unlock for the shareholder there.
Normally you see a price to earnings ratio of around 10 to 20 for companies, and per sector this can be different. And what we see with telecommunication companies, they're so big, it's a saturated market, the price to earnings ratio is typically lower than the market average. But if we look at streaming or media companies, they are hot right now. There's a lot of money to be made. They expect this market to grow. So then investors are more likely to pay a higher multiple for these kind of companies. So by just taking out the assets of the media company into another entity, they think that they can increase the value. AT&T from origin is a telecom company. So they go back to the basics and they will focus on what is their core business. So of course this sounds all very nice, but there's also some disadvantages. So let's go over those. The biggest disadvantage is that they announced a dividend cut, and this dividend cut is as serious as my haircut. They will take off a big amount because when I started investing in AT&T, the dividend yield was around 7%. And because they will take out a big part of their assets, of course their revenue and free cash flow will go down. It's estimated that the revenue of Warner Media was around 30 billion. The current revenue of AT&T is around 170 billion, so take 30 billion out of it, that is a substantial part. But obviously the biggest part is still there, 140 billion out of 170. Obviously, because they have a lower revenue, lower returns, the free cash flow will be lower. So it's normal that the dividend will be lower as well. But on top of that, they also want to decrease their payout ratio. And the payout ratio is a metric that shows you how big of a percentage of the cash flow they're paying out in dividend. Right now, the dividend payout is around 50 to 60%. And they want to decrease this to 40 to 43%. So the first estimate is that AT&T will generate a cash flow of around $20 billion per year. And with a payout ratio of 40 to 43%, this comes down to 8 billion or 8.6 billion in dividend payments. And because AT&T has around 7.6 billion shares outstanding, this means that it will come down to $1.16 per share. So if you compare this with what it is right now, $2.08 per share, it's a decrease of 44%, so almost 50% dividend cut. But on the other hand, we need to take into account that the share price will also be much lower because the assets of Warner Media will be taken out of the AT&T, this also lowers the value of the stock. And it is estimated that the value of the Warner Media assets is around $7.50 per share. If we look at the current market price for AT&T, it's around $29. So if we take $7.50 from that, you have $21.50. So if we then take $1.16 and we divide it by $21.50, then we get a dividend payment of around 5.4%. So in the end, not that bad. But for the media company, especially in the beginning, there will be no dividend payments, and they will focus first on generating unique content and good profits before they will pay out a dividend, if they will pay out a dividend eventually. With all this information, what to do with the AT&T stock? Well, like always, there are three options. You can either sell your shares, you can hold on to your shares and do nothing, or you can buy more shares. So first of all, it really depends on your personal situation. Because if you're about to retire or you are already retired and you had AT&T in your portfolio because of the dividend payments, you might want to look for other companies that pay a similar dividend as AT&T did before. But do notice that even after this serious dividend cut, AT&T is still paying a very nice dividend. And if you compare it with average of the market, they still pay above that. So even though they cut their dividend basically in half, they still pay a healthy dividend. You will get also a share in the new company. So maybe they won't pay a dividend, but that also will have a value. And as the CEO of AT&T said, they expect the multiple of that share to be higher than it is for AT&T. So in that way, there is maybe some value to be gained as an investor. So selling AT&T is at least not what I am gonna do, because I really think that this merger could have some benefits. It creates a big streaming company, and also AT&T will be more focused on what they're good at, on their core business. I believe that's a good thing. So then, should I buy more shares of AT&T? If we look at the chart right now of AT&T, you see that after they announced the news of the merger, originally it went up quite a bit. It went to almost $33 per share. But after that, it was a big decline, as you can see here, all the way down to $28.29 per share. And now it's more or less kind of stable around that price. So it could be a good moment to start buying some more shares of AT&T. Right now, if we look at the dividend payout of AT&T, is on 7.2% in dividend yield. So that's pretty good. Of course, this will change after the merger is completed, but for now, that's pretty good return on investment. And also, if we look at the fair value of the company and the estimated cash flows, I think AT&T could be seeing some big gains, because they lost almost 10% after announcing the merger. And what fundamentally changed about the company? Not that much. They still are a big company generating lots of profits, and they're still committed to pay or share their profits with the shareholders. So for me, it could potentially be a buy. I would like to see it go down a little bit more, and then I'll probably will add on to my position of AT&T. But what I will do for sure is to hold on to my shares, and I just want to see how this whole merger thing will play out. So I'm not gonna sell. I'm maybe gonna buy more, but mostly I will just stay calm and try to see if more and more information becomes available about the plans of the new company, the name, what are their dividend policy gonna be, etc. So yeah, guys, that was it. This was my take on the update on AT&T about the merger with Warner Media and Discovery. Let me know in the comments down below what you think about the company. And if you made it this far in the video, please don't forget to smash that like button. It really helps me out. I really appreciate your time, and I hope I see you in the next one. Have a great day.